Sometimes you may be asked to figure out how a particular discount note transaction impacts the horizontal model of accounting, and you may not be sure how to work that. Well, I'm going to show you today how to do this using this example up here that we had calculated in the past, the discount rate and the APR. If you want to go back to that video, I've linked it up here. Now we're going to presume we go ahead and calculated the APR and the discount rate, and now we have to figure out how to incorporate this information into our horizontal model. I'm Professor Capko, and I help students and budding professionals learn how to do accounting and other subjects. So if you like this kind of content, please go ahead and smash the like button to let me know. And if there's other questions you might have, put them down in the comments and I'll respond if I can, and I may even make a video based upon your suggestion. All right, going back to this, we have a business that signs a promissory note for $20,000 payable to the bank 5 months from today. The proceeds of the note were $19,100. So in other words, it's prepaid interest. This is a discounted note. So the business today receives $19,100 cash, but 5 months from now, they're going to pay the bank back $20,000. And that difference is going to be the amount of interest paid. So this is like a corporate example of one of those payday lenders that you write a check for $100 and give it to them, and they give you $80 perhaps for that check, and then in the future they deposit the $100 check as payment in full of your 80 plus your interest. Similar to that is a discount note. So the horizontal model of accounting shows both the balance sheet and the income statement together. We've got the accounting equation over here in the balance sheet, assets equals liabilities plus owner's equity. And if you need to know more about the balance sheet and the accounting equation, I've linked a video up here that you can take a look at. And over on this side, we've got the income statement, which is net income is equal to revenue minus expenses. And we usually draw a little arrow over here because the net income is going to impact the owner's equity usually in the retained earnings. So there is a relationship between the two, and we're putting them all together. So let's see how the signing of this note would impact the horizontal model for this company. So we have signed a note for $20,000. So that increases liabilities for this company for $20,000. So I'm going to put a plus 20,000 here for liabilities right under there. We receive $19,100 cash. So that increases assets by $19,100. Balance sheet must remain in balance. So we have a problem here because we have liabilities of $20,000 and assets of only $19,100. They are not in balance. We have to account for that remaining $900 difference. So that $900 difference, which we know is going to amount to the amount of interest that we pay back 5 months from now. But how do we account for it today? Well, we're going to put a negative sign here and $900 under liabilities. And that account there is going to be called discount on notes payable. So this $20,000 account is going to be notes payable. And this $19,100, that's going to be in the cash account. So that's in the cash account. So this discount on notes payable, that's called a Contra-Liability. liability account. It's a contra-liability account. It has the opposite effect of the liabilities. It works to reduce the amount of liabilities. So that is how we would set up the initial transaction. There's no impact upon the income statement. So that's the initial transaction. Let's say a certain amount of interest is paid. Well, first of all, how much interest is there going to be per month? So if we were going to account for it every month, and we have $900, and we're doing it over 5 months. So let's see how much it is per month. So I take the 900, I divide it by 5. So the interest is going to be $180 per month. So that's the amount of interest we're paying. So let's say a month goes by and you want to account in the horizontal model for that $180 worth of interest. Well, it's an expense. So I'm going to put it over here under expenses, and I'm going to put a negative sign because we're reducing revenues. To get net income, we're subtracting expenses. This doesn't mean that we're reducing expenses. It just means we're going to subtract our expenses from revenues to get our net income. Hopefully net income. If our expenses are higher than revenues, then this is going to be a net loss. So we're going to reflect this as a negative $180. So that's going to be interest expense, right? We're reducing it by $180. If there was any revenues that come in, we're reducing it by $180. Now, we need another 180. Where are we going to put that? Because we have to balance this. Well, we're not going to take it out of cash because we're not actually writing a check for the $180. This was already accounted for in only receiving $19,100. So where do we offset this $180? Well, we're going to look at this discount on notes payable, and we're going to add 180 to that. Because we're going to reduce our discount on notes payable by the amount of $180. That reduces that by the same amount of the interest expense, and we're going to use up this discount on notes payable over the life of this note. And the last thing I want to show in this would be, what do we do when we pay off the note at the end? Well, hopefully we've accounted for the interest all the way along until we have a total of $900 interest expense. So we would add up this, and then over here we've added a total of $900 to the discount on notes payable. So that's completely gone now. So all that's left is the $20,000 here. So we're going to reduce cash by $20,000. So I'm taking $20,000 out of cash, so reducing it. So I'm minus $20,000. And I'm going to subtract $20,000 from our liabilities because we're paying off that note. So we don't owe it anymore. So our liabilities go to zero. Our discount on notes payable will have gone to zero. And all that's left is whatever cash is in the account after we subtract the $20,000. So hopefully that will help you in dealing with the discount on notes payable in the horizontal model of accounting. I will do another video in the very near future to show these very same transactions in a journal entry. So this is just the horizontal model, and then I'll show the journal entry next. If you have any questions, post them in the comments. And if you did find this helpful, keep your grade alive and subscribe. Thank you.